Hello and welcome to another episode of PS Perspectives. I'm Phil Gioia. I have the pleasure of being joined by Morris Chen, Portfolio Manager and Head of DoubleLine's Commercial Real Estate Team. Morris, thanks for coming on the show today.
Thanks for having me, Phil.
So there's certainly been a lot of turbulence in markets, and commercial real estate has been no exception. You and I were talking this morning just about the sheer number of questions that we've been receiving from clients regarding our thoughts on commercial real estate. So jumping right in, let's talk about fundamentals. And given what transpired last year in terms of the Fed raising interest rates, how has higher interest rates impacted overall commercial real estate fundamentals?
Yeah, I mean, if you think about the commercial real estate world, a lot of it is private. This is a private transaction, private investment type of instrument. And as a function of that, for private investments, such as buying a building, the process of buying a building, it typically gets drawn out. And the point of this is, for us, at least on the initial onset, when we're thinking about markets, real estate buildings and real estate valuations don't move as quickly as, say, the liquid securities market. And that is just a function of that private investment type of dynamic. You can't trade a building with a 3-day settle like a security can. So as a function of that, it's somewhat of the moves in itself. It's yet to be pronounced. But what we can see is typical to most large moves in terms of macro environment. Last year, a significant increase in terms of interest rates that has brought forth a lot of uncertainty for both buyers and sellers of commercial real estate buildings. And we see that, I think the primary way to see that is within transaction volumes as reflected on this slide. A cataclysmic drop or a significant drop is how I would describe it in terms of transaction activity. That is a telltale sign of a disconnect between buyer and seller, right? Buyers have expectations that the world is going to get worse because interest rates are rising. And so buyers are trying to adjust their prices down. Sellers, are a little more optimistic. They try to sell the story of things aren't as bad as they may seem. And so, the prices that they're commanding, could be different relative to buyers. So that's the first step, is this disconnect between buyer and seller. So as a function of that, no transaction is consummated. At least for us, you're definitely seeing that. And we've seen this time and time and again in past crises. I mean, you look at during the GFC as well, as well as previous sort of rate hike cycles, especially when rates shoot up materially, because commercial real estate is often purchased with financing, and especially with the uncertainty that's going on and the lack of clarity of where the terminal Fed funds rates are. That uncertainty just makes it that much more difficult for a transaction to be done. So, fundamentally, the slowdown in transaction volume is the first step. I think you're starting to see, prices starting to roll over, and that's that lag effect. Again, buildings don't trade like securities do. It takes a little bit of time, and as we're looking at property price indices, and even for us ourselves, just from anecdotal conversations, we definitely can see that the prices are coming down. So for the first time on a year-over-year basis, we're seeing that reflected within the property price index. The one we use is the Real Capital Analytics CPPI. So you did see you're definitely seeing quarter over quarter decline in prices at this juncture. So
and that makes sense, right? Given that CRE is generally a debt intensive industry, right? So as interest rates rise, those borrowing costs increase.
Right.
But also, to your point, there's a lot of uncertainty. And one thing that we've been seeing in the news recently regarding uncertainty is what's been going on with regional banks. So how does what's been transpiring with regional banks, right, some of the issues that they're facing, perhaps translate into CRE lending overall?
Yeah. In terms of lending, we didn't see a significant pullback in lending last year. It's not that lenders didn't want to lend. Lenders just, were charging rates that were pricing loans, based off of where the risk-free rate is. And as a function of that, prices were high, right? It was cost prohibitive to borrow for a lot of borrowers. this time around, at least, what's percolating over the last couple of days has been, the developments within the regional banks started with Silicon Valley Bank. And, now I think today there's, talk of First Republic as well. There was another bank, Signature Bank, that went under. I think what is clear to us is that availability of financing, at least the appetite for regional banks to want to lend, at least for the indefinite future, in terms of the immediate term to maybe perhaps medium term, is banks are now focused on shoring up capital. The willingness to lend in itself is largely dissipated. And as a function of that, if we think about regional banks over the last 4 years, and as it relates to the regional bank side, they were a pretty prevalent lender within the commercial real estate space, primarily in the middle market lending arena. When we think about banks with a balance sheet of around 10 billion to 250 billion, which is somewhat categorically descriptive of what a regional bank is, these banks were making up anywhere between 15 to 20% of the market share in terms of capital within the real estate market. So if these banks are pulling back, you're going to see capital also, at least from an option perspective. If you're a borrower or you're a buyer of the building, you're a borrower, you're looking to refinance, you should see that your options, your capital options is going to decrease. If you're a buyer, you should also see your capital options decrease, especially with these banks stepping back in the interim. I do think that the outcome of this in itself is more of a restrictive lending environment. But at least we're looking at the regional banks in real time, and that's what we're seeing.
So in terms of the more restrictive lending environment, right, there are different property types within commercial real estate, right? You have multifamily, you have retail, industrial, office. One property type that seems to be facing the most headwinds, and we're certainly getting the most questions on, is regarding the office space. So what are you and your team's thoughts, on office, right? How does your outlook kind of on office look going forward?
Yeah, and clearly office is a big topic. There's a lot of negativity, but kind of going back to the previous slide, I'll give you an example. If you think about LTV and loan to value across the commercial space, and this is indicative of what a lot of the banks, as well as even the CMBS, commercial mortgage-backed securities vehicles own in terms of collateral or in terms of real estate loans. LTVs have actually been, somewhat measured, relative to the historical average. If you just look at the last 3 years, LTVs for commercial were in the, mid to high 50% range. Whereas, as it relates to the multifamily world, we were in around the 65 to 70% range, and even lower below the historical averages. So, I think, a mitigant to a lot of the negativity within rationalizing or thinking about risks, yes, while there's headwinds for commercial in terms of lack of availability of capital, but at least I think for us, leverage is manageable. I think, going into the office space, knowing that kind of going into the office space, loans were structured appropriately, at least in terms of leverage. Now, the dynamic of office is very different these days. I do think that, there might be situations where the mortgage may potentially be impacted, based on losses. But I think, as we're thinking about the office world, one kind of needs to think about what's working, what's not working, which is the next slide. Phil, as you kind of alluded to, what I think is a very clear trend is, here we're kind of looking at demand for office based on the vintage of the building, meaning when the building was updated and when the building was built. I think here it's really, this is more reticent of buildings by build year. So newer buildings, have seen positive demand or positive net absorption, meaning, there's more demand than existing space. And then, as it relates to buildings that are older, you're starting to see more prevalent signs where tenants don't want to be in an older building, and they're vacating, and landlords are just having a more difficult time backfilling those type of spaces. So vintage is one clear dynamic. So as we're thinking about office buildings, there's a small cohort that's newly built. I think there are some examples within New York City that are doing okay. But with that said, taking a step back here, I do think there's too much office space within the United States, given some of the secular changes that's ongoing. Relative to the availability of capital, if you think that regional banks are dialing back risk, well, I think on the office side, all banks are dialing back risk, and most lenders are dialing back risk as well. So, office is unique in that sense where, the availability of capital is shrinking. And then in conjunction with, the prospects of secular changes in terms of use of office, which will just add a little bit of, further stress within the office space.
And I think that's what a lot of the questions are stemming from, right? You see a lot of headlines regarding defaults on these office buildings, right. But I think you make really good points when you speak to clients, and defaulting is really the first step in the process, right? So can you talk about when a property does go into default, kind of what the next steps are from there?
Right. Thinking about going back, you need to think about leverage metrics and the embedded equity value that is in a typical commercial transaction. So, generally speaking, within the mortgage, so basically the senior loan against an office building, LTVs can range, as low as 50% and as high as 65%, and that's on average for a first mortgage loan. So when we're thinking about office there, you inherently have 35% of equity to maybe 50% of equity. We are in this world where things are changing, rents are falling, occupancy is declining, as a function of demand, and then available capital is more expensive. But with that said, you do have some cushion as a mortgage holder of an office within the securitized products world. For example, a AAA security from a leverage, if you just look through of what is deemed a AAA bond, your exposure to that office building may be in the 25 to 35% LTV range. So, if you think about equity cushion, 65% of equity or protection that's beneath you, add, some of these AAA bonds. It's very hard while things are moving. I do think that there's a lot of, certain sort of investment profiles that are protected by that. But we're thinking about office from a standpoint where every deal is unique, depending on which market it is, depending on what the borrower decides to do. A lot of these defaults that we're seeing right now, I think in the interim, the resolution, at least the conclusion of these defaults, may take years to pan out. And as much as the headlines that we're seeing in the news like to report, some of these defaults, I would take it with a grain of salt. The conclusion, it's not necessarily the conclusion. Some of these defaults may be strategic. I think some of the trends that will likely percolate continually will be additional defaults because now borrowers, as well as owner of these buildings, have a reason to default, meaning they see someone else default and potentially engage in negotiations. So, they may also try to default as well to try to enter into negotiations and get ahead of, the impending issues that they may see. So there is a little bit of a first mover advantage coupled with a Me Too type of mentality here. But the first action is you have to engage in discussions as a borrower. You do need to put the property into default to engage in formal discussions for any sort of reprieve, whether it's modification, whether it's an extension, whether it's a loan mod, these things take time. Not to say that a lot of the borrowers will come up with good deals for themselves, But I also do think that, at least from a lender side perspective, lenders are also, at least at this point in the cycle, a little bit apprehensive of wanting to own these particular office buildings, just given the uncertainty. So conclusions in terms of workouts will take time, and I think this will take a few years. So
I think I've heard you use the term glacial pace.
right,
And I think the main point too is that, these defaults, not all of them will ultimately go through foreclosure, right? And liquidation, right? It's, to your point, the first step in working out potentially better solutions, whether that's through loan modifications, through extensions.
CMBS markets.
Right. Each property type is unique, right? Outcomes will likely be idiosyncratic. And as CMBS investors, you can choose where, not only from a property perspective, where you want to invest, but also in terms of the capital structure, right? If you want to be in the senior portion, if you want to take more risk, right, you can buy lower rated, or you can buy the B piece or equity pieces of those securities. But I heard you say in a recent webcast, with what comes headwinds also comes opportunities. So when we're thinking about the commercial real estate market, right, there's certainly a lot of headwinds for certain property types and depending on where you are in the capital structure, but I think there are opportunities for investors out there. So, given that there is a potential for these large variances from the mean, whether that be from a property price perspective, whether it be from cap rates, from issuance, from spreads, if you and your team were given a fresh pool of capital today, where do you see the most relative value across the CMBS market broadly?
I think with all that's going on, there's opportunities at the investment grade portions of the securitized CMBS market. And when I say investment grade, the higher you are within the investment grade structure. So starting at the AAA level, we think there are unique investments. Here, you're seeing the yield premium pick up relative to CMBS AAAs relative to investment grade corporates, and also the yield premium pickup in CMBS single A's versus high yield. By way of example, single A's are effectively trading trading cheaper than high yield, and that gives you a sense of, and those are junk bonds, but that gives you a sense of the uncertainty that's going on, and the unwavering nervousness in the CMBS markets. So, not to say that, it isn't without risk, but, there are times where when you pour out the water, everything is poured out. I feel like at least at this juncture, parts of the CMBS market sure feels that way. But, perhaps maybe one shouldn't pour out everything. There's some things in there that are actually okay. But again, not without risk. Clearly, it's a market that requires active management.
Yeah, a lot of due diligence, and you and your team have certainly done a lot of due diligence, looking through all of our portfolios and really curating what we believe are the best investments for our clients.
Right.
So Morris, thank you. We covered a lot today. Thank you so much for joining the show. For those that would like to learn more about CMBS, Morris and his team recently published a paper called Intro to CMBS. That can be found in the link below. We also have additional resources on DoubleLine.com. So again, Morris, thank you. And any questions, please reach out to us here at DoubleLine, Product Specialist at DoubleLine.com. Thank you.
Thanks, Phil.